Hi, and welcome to Dollars and Making Sense, a weekly program about finance, money, and investing on Radio Northern Beaches and broadcast nationally on the Community Radio Network around Australia. I'm your host, Ray Treverson from OTG Capital, and today we're welcoming to the microphone David Jonavicious. No, I got it wrong. Jonavicious, David Jonavicious, a subject matter expert and tax specialist from the Institute of Financial Professionals Australia, formerly Tax and Super Australia. Welcome to the show, David.
Thanks, Ray. Good to be here.
Now, as a little bit of background, we have a lot of IFPA specialists come and chat to us. We've had Natasha and Neville and Frank has been on the show just recently. Can you give the listeners a bit of a background of where you've come from, how you ended up at IFPA, and I guess your specialty?
Yeah, no problems. I've been with IFPA for just on 18 months now. And prior to that, I'd come through a variety of small, right through to large Big Four firms specialising in tax. And yeah, it just seemed like a natural progression to join up with IFPA, where I could devote myself 100% to tax and tax advice for members of the organisation.
Now, you hit me with a bit of interesting information that by the time this goes to broadcast, you most likely won't be with it, but you're actually moving on, aren't you?
That is correct. Unfortunately, one of those too good to refuse offers came along, something that had been on my job list for a while, and that might make a few of the listeners laugh, but heading to the Australian Taxation Office.
Yes, the evil empire. You're going to headquarters. So we joked about that, ladies and gentlemen, off air. But I must admit, I think some time at Mothership is probably a good thing. That gives you, I guess, a certain string to your bow as your career progresses, wouldn't you say?
Yeah, pretty much. That was one of the key reasons. But yeah, obviously the opportunity, I suppose, to work right at the coalface with my first love, tax, is yeah, just a good opportunity. And but having said that, I'll no doubt still be in touch with the team at IFPA, and hopefully at some point I may end up returning.
So there's a statement you won't hear often, ladies and gentlemen. My first love, tax. Okay, I'm going to put that one down in my blog as one to remember as we go forward. But thanks for that. I'm sure Natasha and Kai at IFPA will love hearing that. I'm sure in the recording. So look. The reason we've got you along today, David, is we're going to be talking about private company benefits and Division 7A dividends. Now, that sounds a bit of a mouthful, but in essence, for the listeners, if you can encapsulate that into some common English, what does that actually mean?
Yeah, so look, to break it down to its simplest, I think where a lot of particularly mum and dad operators who may have been established in a corporate structure by their accountant in small business often don't realise that the company is a separate entity to themselves, and therefore the money and the profits that the company makes belongs to that company until such time as the company deals with that, whether that's paid as wages, a director's fee, or a dividend out to those shareholders. But obviously, in practice, a lot of mum and dads, in particular, will treat that money as their own. And there is a section in the Tax Act called Division 7A, which is the focus of today, which captures, I suppose, where a shareholder or an associate of a shareholder has taken money from a company that's only been sheltered at the corporate tax rate and forces that shareholder to either or deal with it a number of ways. One of those ways is to assess that shareholder on a deemed dividend, or there is the alternative of putting it under or repaying it, obviously, is probably the easiest way, or
Mm.
the other common way is to put it under a complying loan agreement, and the legislation does cover off what that actually means and what those requirements are to be complying.
See, it's a funny thing when you talk about how you treat money. One of my very first clients when I became a financial planner a number of years back was a tradie. Lovely guy, was a good tiler, great tiler actually. but an absolutely hopeless bookkeeper. And I had to sit down with him and say, listen, buddy, that's not your money. He says, yes, it is. I can access the bank account. I can put money in and withdraw anytime I like. I said, yeah, I get that. I said, but it doesn't belong to you. Actually, it's in the company structure. And he goes, yeah, but I control the company. I said, yes, I get that. And I guess this mental breakthrough, David, trying to breach the chasm to say it's not yours yet. And so, you've got to breach that bridge that then says when you pay yourself, you have to pay tax. Oh, right. And so there was this all of a sudden. I'm sure you've probably had this with when you're talking to people on your IFPA hotline and they're asking for advice. The penny drops and they go, "Oh, right. Oh, is that why you have?" Yes. And so we have those discussions. And so I guess when I read some of the notes that you sent to me in preparation for today's chat, Division 7A is part of the Income Tax Assessment Act, dating back to 1936, ladies and gentlemen. It goes back a long way. And it's intended to prevent profits or assets being provided to shareholders or their associates tax-free. Now, I think that's an interesting discussion point there alone, David. Talk about associates a little bit so that people understand what that is. I think people get a good idea what a shareholder is, but in terms of the tax code and 7A, what's an associate?
Very, very broad. For anyone who's ever worked in tax or looked at the Tax Act in any way, the term associate is bandied about, obviously, in many areas, and on almost all occasions, it's referenced back to what's known as a Section 318 associate, which is just the section reference in that 1936 Act. And when we're talking individuals, for example, we are talking uh, relatives of that individual. They can be the spouse, children. We're talking about if that individual has a controlling interest or can significantly influence another company, then that'll bring that company into the net. And
Mhm.
in terms of trusts, if they can and do benefit as a beneficiary under a trust, well, that trust will also be an associate of them. And that is by no means covering all bases. That's just the tip of the iceberg. So in most cases, the answer is usually if you can think of somebody, they will generally be an associate, unless you can show under the legislation that they're not.
And I guess for those of you that are out there listening to this and you might ponder spouses or people of equal distinction, and I will let your mind roam wherever your mind decides to roam in that regard, that I'm sure the tax office and the tax commissioner would look very dimly where you say, but that person's not my wife or husband, but your carryings on would suggest otherwise. And we will leave it at that. I know this is a family show, but let's keep on moving. So we know what a shareholder is, and we certainly know in that regard that an associate is a fairly broad interpretation by
Yeah,
the commissioner. But I guess what we're really talking about is when people start using company money and company assets for things that aren't company related. I guess that's in essence what we're talking about here, aren't we?
100%. So, I mean, at its most simple, many people will, or the easiest way to look at it is the simple case of drawing a loan from the company, or the company paying some sort of private expense of yours on your behalf. In either of those cases, the legislation captures that straight away. Perhaps the one that people may not think about as much is where the company may provide the use of an asset that it owns, and that can range from property through to uh, a boat, or anything in between, pretty much any asset, to a shareholder or the associate, and that shareholder and associate doesn't pay for that use effectively.
But that's different, for example, if you provide an employee a company car, because that's FBT, then we're talking fringe benefits tax. But we're
Correct.
now talking
So
about shareholders and their relationship with the company is very different to that of, as, say, a paid employee, isn't it?
that's correct. So in some cases, obviously, where shareholders are also working directors or working employees in the company, there will be a crossover point, and ultimately, it does need to be looked at on some occasions whether that benefit is being provided because you're an employee, in which case it'll generally be captured by fringe benefits tax, or if it's being provided because you're the shareholder, the controller of the company, then essentially Division 7A will be there to capture it. There is actually an ordering in the provision, and Division 7A does override FBT in that regard.
Yeah, I guess it's one of those. I always like to think simply. I'm an ex-army person, KISS principle, keep it simple, stupid. And I always like the term a reasonable person would think. And I guess I look at these provisions, and having read the 7A, the Division 7A notes that you sent through to me, David, I look at this and think to myself, it's reasonably common sense. I mean, anybody that runs a company, there aren't too many people that are going to step up and go, "Oh, gee, sorry, Mr. Tax Commissioner, I didn't realise." I just sit there and go, "Yeah, of course you did. Come on, you knew you're jimmying the system here." Because when you're talking about payments and other benefits affected, I'm just going to read directly from the notes here. It says private use of company assets, transfer of company assets, gifts, loans, other forms of credit, writing off or forgiving a debt, guarantees, payments of loans by a trust, payments and loans through interposed entities. I mean, it's a pretty wide ranging thing that says, hey guys, if you're doing this for anything other than company reasons, it's 7A. I mean, that's a fairly reasonable assessment, don't you think, David?
Yeah, I think that's a fair way to look at it. Ultimately, it's usually quite simple when we're talking about a mum and dad company where there may just be one company in the group. But these days, for asset protection reasons and the like, even smaller enterprises may divide their operations up into multiple companies, and that's perhaps where it's easy to get lose sight of some of the issues where money is transferred around the group and money may be extracted from different companies at different times. So yes, ultimately, as a shareholder, you do need to keep an eye on the fact that you shouldn't just be taking money from any entity in the group whenever you feel like it. I think you really do need to manage that process to avoid problems when it comes time to the end of the year and a stern phone call from your accountant trying to sort this out after the end of the year.
Well, look, it's just about time for a break here on Dollars and Making Sense. And look, when we come back, David, we're going to talk about complying loans and what that means. And I think resources that people should be able to go and look at, not just within IFPA, but generally out and about in the big wide world. So you're here on Dollars and Making Sense. I'm Ray Treverson, and we'll be back in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. And welcome back, ladies and gentlemen, to Dollars and Making Sense, a weekly show about money, finance, and investing. I'm your host, Ray Treverson, and at the microphone today, I have David Jonavicious, a subject matter expert on tax from the Institute of Financial Professionals Australia. So, David, when we were chatting during the break, we were talking a little bit about the kind of things that constitute, I guess, what is a benefit to a private from a company. And I guess we're going to talk about now, really get into the meat and potatoes around, what you do to, I guess, avoid getting trapped by Division A type things. And one of the things that I read there that comes through over and over and over is a complying loan. So let's delve a little bit deeper into that. So what is a complying loan, and how would somebody set something like that up?
Yeah, so in the circumstance where the shareholder, for example, has taken out a lump sum of cash during the year, and has used that money for whatever purpose outside of the company, and therefore doesn't have the ability to repay that loan, which, as I said, was perhaps the easiest way to avoid the consequences of Div 7A. The most common occurrence is, and your account will always be going on about this, which is to set up what is called a complying loan agreement under Division 7A. And effectively, what that does is there are a few basic requirements which any accountant will generally be over in terms of what that written agreement needs, but it sets up that loan to be repaid principal and interest over 7 years at what's called a benchmark interest rate, which does change each year, and it's referenced to a Reserve Bank home loan indicator rate. So unfortunately, the cost of a Division 7A loan has gone up substantially in the last 12 months, that's for sure. And as long as you make a minimum payment, and there is a formula in the legislation, but it's effectively just the 7-year P&I loan. As long as you make that minimum payment by 30th of June each year into the company, and the company declares that interest component, then effectively Division 7A won't deem a dividend to have been paid to that individual. So you have the opportunity to repay.
So, if I'm thinking out aloud, given and because I run a fund that my life and day is around interest rates, and so when you're buying and selling money, and we've had, again, you've rightly said, we've had a lot of interest rate fluctuations in the wrong direction, I guess, for many people. What that also means, though, is that because this benchmark rate, only gets adjusted once a year, that would actually present directors and shareholders an actual opportunity to be able to draw funds from a company at a reduced interest rate, fully legally, and it not incur a potential liability. Am I correct in saying that?
There certainly are opportunities to time it. So that interest rate does float throughout the life of the 7-year loan. It's not a fixed scenario. So unfortunately, it is variable. But what it has meant is that a loan in the current year. Hang on, I've gone offline there.
Keep going, you're fine.
Yep, just come back in. All right.
Yep. Okay, you
Yeah,
were
so
talking about
that
a loan at a certain interest rate. So just pick up from that. So
so
a
the
loan
so
at a
the so
certain
the
interest rate.
The legislation references that Reserve Bank indicator rate, which is, as I said, the home loan variable rate, which may not equate to the rate that you're paying on your own home loan, but it's the one that the RBA uses as an indicator. And yeah, you can certainly, I mean, if for whatever reason you wanted to pay a higher interest rate to your own company, there's no problem with that. You just can't be under that rate.
Okay. No, that makes sense. So there's minimum. So your accountant would have all of this at her or his fingertips and be able to, I guess, readily set that kind of thing up. And I guess in your experience, David, is this something that you see happen a lot? And the reason I asked that question, let me be specific, is that, I mean, I've operated my own company now for 20 plus years. I've never loaned myself money. And the reason being is exactly this kind of thing, that I don't want to mix my private money with my company money. Now, every time I see people doing that, for me, it's a recipe for disaster. I mean, there's opportunity to potentially work the system, if you are moving reasonable amounts of money and you can hedge against an interest rate movement. But from what you're saying, though, it tends to be people either A, don't understand the legislation properly and think that that's their money, or B, they're just plain stupid, or they're being nefarious and by design, and going, oh, you mean I can't do that? And looking very innocently with fingers under their chins, going, "Who, me?" Or is that the thing? Because I mean, I would not necessarily sit there and go, "Hey, I'm going to lend myself money out of my company account." It doesn't make sense to me day by day.
Yeah, look, I think there are generally two common scenarios that are encountered in practice. One is where money is just taken whenever a director shareholder feels like they're short of money and grabs the company checkbook out and writes from there instead of their own account because there's surplus cash in the company. In those scenarios where I guess it's a day-to-day living expense and it's happening on an ad hoc but regular basis, often the better way to handle that scenario is to simply have the company pay that out, whether it's as wages or a dividend at the end of the year, because
Mm.
invariably that's just going to be a pattern that keeps on repeating. Perhaps where Division 7A and particularly the complying loan agreement scenario becomes more valuable is where, for example, your company has been, has had a successful period, has built up a substantial bank of profits that it may have surplus cash floating around. You don't necessarily want to extract it yourself and pay top up tax at this point in time in one hit because your personal rate might be on the top marginal rate. So there is an opportunity, for example, now you may, for example, have an investment in mind. Obviously, property is the usual favourite of most people. So, for
Hmm.
example, you may pay whether that's the deposit for an investment property, or in fact, you may have enough cash available to simply go out and buy an investment property in full. You've then got, I suppose, the opportunity, instead of relying on the banks for finance, you can actually effectively treat your own company
Mm.
as the
That's a good
financier.
idea. Yeah.
At the moment, as I said, a standard complying loan is 7 years. So obviously, depending on how much you take out, that can result in some fairly hefty repayments on an annual basis. Um,
Hmm.
as the law stands today, and I might come back to that point in a moment, but there is also the opportunity of securing by a registered mortgage that Division 7A loan against property. And as long as it is secured to at least 100, I think the number is 110% of the value of the loan
That's
with
correct.
property, yep, then you can actually extend that out to a 25-year Division 7A loan, which for
Yeah.
many people will effectively be much like a standard home mortgage.
Yeah, and I must admit that caught my eye when I saw that. I went, "Oh, wow, 110% financing with an asset." But again, you are doing it against yourself. So, if you bail out, you're bailing out on yourself. And so, I guess it's one of those interesting factors. I must say, in many of the shows I've done over the last 4 years, David, I've read far too many stories where their company profits are rated on a regular basis. And my immediate thinking is gambling. And people that are raiding the corporate account because they've got a habit that can't be sustained through their own personal assets. And I've read horror stories. I guess you'd see the same as well.
Yeah, I think, as I said, you can distinguish. I mean, there are the most common scenarios where it simply is used as a personal bank account, and whether that is just for the day-to-day expenses or, unfortunately, for addictions or needs and things like that. And absolutely,
Mm.
over my years in practice, unfortunately, I've seen people fall into that trap. Unfortunately, the tax law looks straight through that. There is no concession or anything like that for an individual. The, the Division 7A will still apply and treat that either as a dividend in the year that you take the money out, or you can obviously repay or put on a complying loan.
Yes, I don't think the casino gets that much favour, any deference to the commissioner, I think, in those considerations. Now, again, referring back to your supporting notes, there are also ways and means of calculating those assets, the transfers, and I guess in the interests of time today, I think the best thing, one of the things that I like to do in our discussions on dollars and making sense is provide resources and a next step for people to really latch onto, because when we're starting to look at the transfer of assets, I think we're starting to get into some complexity there. But the use of assets also comes under Division 7A and must be considered. So that's something maybe for another time. But David, one of the things I think in finishing up our discussion today, if people out there are curious and they are in a bit of a mess, and we talked about this before we came on air, the ATO is a generally good bunch of people to deal with if you're on the front foot. So if you've got Division A questions or you're not sure, where's a good place to start?
Yeah, I think, look, like with many areas of the tax law, the tax office does have some very good information up on its website, which does go into quite a good amount of detail for common scenarios, and also, as you noted, the methodology of calculating the repayments and the like. Um, Again, obviously, if you're in business, you most likely have an accountant. If your accountant is not aware of Division 7A, and unfortunately they are out there, that's probably a good tip to find a new accountant.
Wow. Yeah, I'd say find a new
um,
accountant. Yeah.
yeah, exactly.
Get in
They
touch with IFPA, ladies and gentlemen. Get in touch with IFPA because they know where all the tax agents are.
That's right. But yeah, look,
Shameless
we do
plug
have
there.
some.
That was the shameless plug, by the way.
We'll take that. We certainly have some resources on our own page, but yeah, I think, look, ultimately there's plenty of commercial providers, accountants, and lawyers out there who'll have published plenty of data on it. But in all honesty, for a basic rundown, without avoiding hitting up the 1936 Act and all the sections that make up Division 7A, where it does get quite wordy and technical, yeah, I'd say the tax office website would be probably the best place to visit, or sit down and have a chat with your accountant if you're not clear on what's happening with your company.
Advice, David. Great advice. And so, ladies and gentlemen, other things that you might want to consider when you have that conversation also comes around fringe benefits tax. It comes around imputation, withholding tax, family law settlements. So all of these things get tied up, I guess. And I think one of the things I like the best, it says here under this heading, avoiding issues in the first place. I think that's really sage advice, don't you, David?
There's some very good pointers under there, and I think it's always a case of trying to avoid the problem rather than dealing with it in hindsight. So, yes, if you're a an investor or a business operator with a company, and any of this has caused any alarm or any red flags for you, definitely just look into it and make sure that you are compliant, because yes, the outcomes if you're not compliant can be quite nasty.
Right. And look, so thank you for listening to Dollars and Making Sense, a weekly program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. We welcome questions and your feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favorite search engine. David from IFPA, thank you so kindly for being with us today.
Thanks for having me on, Ray.
Wonderful. And until next week, ladies and gentlemen, it's adios.